Hello everyone, welcome to the Grow Your Future podcast. My name is Zah Azmi, I am your host, and I'm joined by my co-host, Sam Eljaban. How are you?
I'm great, man. How are you?
Good, good. It's my birthday.
Your birthday?
No, Luxland's birthday.
OMG. How old are you?
10.
Oh my God, 10 years old.
10 years old.
What a milestone. In business, that's a fucking achievement.
Oh man, it's been a
Massive
rough 10
achievement.
years.
Oh, I can imagine a roller coaster.
Very eventful 10 years. If I could go back and think about why we started the company, and I had a business partner at the time, and we needed a company to do a small scale development. It was a 4-pack of townhouses.
Yep.
And that's what started the company.
So the original intention of creating that company was like a SPV, just to do a project or something.
Correct. So it was, that's where Luxland Investments came from,
Yes.
Proprietary Limited.
Okay.
And we never thought that it would become what it is today. You know, we just thought it was just a nice name. I always liked Luxland because I've always viewed land as being the ultimate luxury. You know, it really does, sort of solidify your future if you can hold it and control as much of it as possible. But yeah, we embarked on a 4-pack development in a suburb called Blackall's Park, which is near Newcastle. And back then you could get residential lending on 4-packs. The site itself only cost us, I think, 300 grand. And it was DA'd, ready to go.
Wow.
And look, we carried out that development, and it was a lot harder than we thought it was going to be. But it was a great experience dealing with the builders and, delays and all of the arguments between the trades and all of that sort of thing. But then when we completed the project, we made a profit, but it just wasn't groundbreaking. You know what I mean? We did it more so for experience.
Learning the ropes and all that kind of stuff.
And then as time went on, we started looking at other deals. First of all, we had to sell those products. And then when we sold those products, a couple of our friends bought a couple of those townhouses as investments. And then we were still looking for sites after that. And then what happened was we had a lot of other people come up to us and say, Zah, you're the property guy. Can you help us find us a property? So then I'd help people just find properties online.
I see. Yep.
Right?
Yep.
And then my business partner at the time said to me, he goes, Zah, you should actually start a business because this is a service that people would actually pay for. And that's when I started going, okay, well, I at the time I think it was only about 3 or 4 properties. They were all existing cheap properties. Most of them were on the Central Coast because that's where we grew up, right? And I thought, okay, well, I'll just help people get property in Central Coast and Newcastle because I know those areas. And we started the business as a consulting firm. And look, it was hard. It was.
Well, you'd be going back 10 years to 2014-ish, 2015. That was before all this, because right now there's a big emphasis on the buyer's agent investment. It's a big,
it's massive now.
Massive
it's
industry.
massive.
So you would have been one of the early pioneers.
One of the first ones.
Yeah.
So what happened was we had a little bit of a break where I wasn't really advertising my services that much, and then I think it was like 2016, 2017 is when I started branding myself as Luxland, and sort of going out on social media and all of that sort of thing. And it was tough because we were entering into a time where APRA was coming in and tightening up lending. The market actually shit itself and had a really sharp downturn, and no one was buying property. Yep. So it was really hard. I would say the first 5-6 years of running the business was so hard, and I was really just advising clients on what I had done previously. So it was good because I was getting a lot of experience from it, but it was also bad because I wasn't making any money. I was actually losing money because I was paying staff at the time. I was paying, other expenses. We weren't making that much off a deal. Remember back then, properties were, they were cheaper. So, our percentages in terms of margins weren't really there. And so it's just been a journey. And then, I've tried every single strategy out there. I've actually been investing for 15 years. So when I entered the business, I was sort of, or when I started the business, I had already had, 3 or 4 really good investment properties behind me, had a bit of experience that way. So I felt like I was sort of qualified to...
Well, you knew more than what other people generally, the lay would know.
Correct.
Yeah, so you had a lot of value to give.
And it was funny because in 16, 17, when I decided to really, go to market and sort of advertise myself and brand, Luxland and, get on social media, I didn't actually really have much to my name. And traditionally, these other, I guess, buyers agents and property investment firms were run by people that were quite flashy, right? Like they had the cars, they had, the suits, and they had the lifestyle, right? And I sort of didn't have that, and I felt like a little bit of a fraud. But the reason why I didn't have it was because I was pouring all of my capital back into more property. I was trying to buy as much property as possible. Yeah. And I remember when I first went to market, I was driving a Toyota Corolla, and I actually had the Luxland logo on the side of the Toyota Corolla. And
I remember seeing it in Canada.
Yeah, and I had, a couple of suits that I had owned, and I was like, okay, well, I'll just wear that and really just give it a crack. And I copped so much flack for driving a Toyota, telling everyone I was a property millionaire, but not really showing that I really had the lifestyle or even, the things, all the trappings that most property investment firm CEOs had, right? And I was trying to brand myself as this expert. Very, very hard, because people are calling you a fraud. They're just judging and criticizing you, going, what would you know, and all of that sort of thing. Yeah. But you know what, like I did that for a long time, and then, moved into where I'm at now. And, thankfully now I have, a quite sizable portfolio it's not really a priority for me to keep growing that, because it's sort of at a size where I'm quite happy with. My focus is more on, growing the brand, helping my community, helping clients, which is really the I guess the cornerstone of what the business is about. But yeah, it's been a wild ride over the last 10 years. And I guess what we want to talk about today is all of the different strategies that I've tried to get me to this point. And there's a lot of stuff on social media at the moment with other property investment firms basically bagging the shit out of different strategies, basically the strategy that's not theirs, right? Yep. So whatever strategy they're not doing, they're just basically saying it's shit, which I don't believe that is the right way to go about explaining property, because each different property strategy has its own merits and it suits a certain type of demographic or target market, right? And there's something out there for everyone. And I think what we want to do today is sort of flip it on its head. And the thing is, all of these other firms that do these strategies, like I've actually done them. And we're going to go through them today and my personal experiences with them. But we're also going to talk about the pros and cons of them, right? Because there's a purpose for why these products and strategies have been created, because there's something that you can get out of them. And it might not be all of the things that you're looking for. So, for example, we're looking for capital growth, cash flow, tax deductions, affordability, all of these things, right? We want good locations, all of that sort of stuff, or locations that are good enough for your budget. It's very hard to hit all of those things all at once. And this is where these other firms will focus on negatives and go, that's why that other strategy is shit. And then my strategy is the best one to go with. But this is the issue. Out of every single strategy, including my one, there's going to be negatives. There's always negatives. It's just that, is it right for that particular client? Because sometimes clients come in and I'll actually refer them to other firms that, I guess, conduct different strategies.
It's more suitable for them.
It's more suitable for them, right? So I'm going to not bag I guess I'm not even going to say my competitors. So these other firms, I'm not going to bag them out. I'm actually going to I'm going to praise them because they've actually got a good product. And I'm friends with a lot of these guys, and we're all in the industry together. We're just trying to make, I guess, the world a better place and get more and more people investing. But I'm going to praise them because they're actually doing a really good job, and their strategies are out there for their demographic, and I think they're really good, right? I just think people need to be aware of the differences, right?
And I think every strategy works. It's just depending, does it suit you? Is it going to achieve what you want to achieve? Is it going to get you the result you need or require from that property? So everything will have merits. There'll be no unicorn that'll tick all the boxes. Everything will have pros. They'll all have cons. It's just weighing up what's going to suit you best.
Sure. And we don't want to generalize, right? And I think that's where it must be just a marketing strategy for them to go, okay, it's easy for me to say house and land shit, right? It's rubbish. You should just look at my strategy because it's the best, right? But it's such a generalized comment because how is house and land shit when we've done so well out of it? You know what I mean? And vice versa as well. We've done so well out of these other strategies that we no longer recommend our clients to do. So let's start off. 15 years ago, I started investing in cheap property. So it was 340 grand was my first property. It was old. It required a lot of work. It was on a big block of land, which was really good. It was on the Central Coast. Look, that property now is worth $1 million. I don't regret buying it, but it's given me a lot of headaches. You know what I mean? It did really well for me in the beginning. I was quite fortunate because I had a pretty good income back then. So like if I had maintenance issues, I could throw at it. If it had a lower yield because it was an older property, I could make it up for the negative cash flow from my income. So I had trouble with tenants because we were having, sort of a bad run with the types of tenants going through. So there was a high turnover. So there were quite a few negatives with it. But I guess the positive was it grew in value in 18 months to, I think, $450,000. So there was a lot of usable equity that I was able to use. And it was great timing as well. And so I bought property like that for a while, for a good, say, probably 4 or 5 years.
And just to expand out from that, there's still a market for people buying cheap property. So I guess back in the day when you first started, that was entry level. It was sort of what I could do at the time. I haven't dabbled too much in it. I don't want to put $1 million. Maybe I don't have it. I can't do that anyway, but it was a cheap property. It's what I could do at the time. Where now it's an actual strategy where people focus on the cheap property, and it might have, like it happened with you, over time, maybe a very longer term, you'll get some benefits from it, but there are some cons. Well,
what happens is you accumulate these cheap properties. Oh no, I wouldn't call them cheap. They're just existing, and they're semi-blue chip. They require a lot of work, and you do all of that sort of stuff. And they have zero tax deductions, which I didn't really need at the time, admittedly. So it was sort of perfect for me. I had a bit of an income, so I could make up the negative shortfall from the lower yields. But you know what? Was it sustainable, Sam? No, because if you've got 5 properties that all require work, if you've got 5 properties that are lower yielding, they're very hard to hold because it all adds up, and it forced me to make change, right? And this is where I had to change. So the pros of it is that you do get good capital growth if you're in great locations. I guess you can chase those yields as well. There's some really good guys out there who chase the market, and they might go to Perth and they might do Hobart, and they chase different market cycles, which allows them to get those yields and pick up that quick growth as well. That's a fantastic strategy as well. But you really do need, I guess, a pretty wide contact base to make sure that if any problems were to occur, you've got a really rock solid property manager, because nothing's covered under warranty. Obviously, you're having to fork it out yourself. You want to make sure you're not getting ripped off on trades. So it is a strategy that works, but how sustainable is it? I don't know. You've got guys out there saying, I've got 100 properties like this, right? And it's like, I just would not want to be in that guy's shoes of owning 100 established older properties.
Yeah, and I think it has its place. Like, I guess the reason you moved, say, on from that cheaper property type acquisition would have been probably twofold: education and knowledge you developed, and then maybe your money situation got better. So I think it has its place, and maybe staying in that space and accumulating to that level might just be, you'll get the benefits over time, but it might be maybe an inefficient way to go.
Yeah, and I think these guys who sort of spruik the fact that they've hold these massive portfolios and they've got 100 plus properties, not everyone's going to do that. No. And that's what I had to come to terms with as well. Is like I didn't even want to do that because it didn't work for me. It might work for these guys, but it doesn't work for me, and it doesn't work for my clientele.
Yep.
My clientele are time poor. They don't have endless amounts of income that they can keep throwing at renovations and all of that sort of thing, or even maintenance. Yeah. So they need something a little bit more easier, a little bit more digestible, something that's just going to be a little bit more passive than that. But also, as a business, it was tough because you're trying to show people that, hey, buy this shit looking property. And it was hard, right? And like you and I both know that there's a lot of value in it. But the general person, the general public will look at it and it's hard. So you're trying to, 50% of you is trying to win the client over to go, hey, do this strategy. The other 50% is actually going out and finding a deal as well and fighting with the agents. I found like it was a lot of work and it was a lot of time that I had to go through for very minimal return. And also, it wasn't something I could scale. Not so much for me as a business, but for the client.
Yeah.
Like I can't see the client owning, say, between 5 and 10 of these older properties. Like I wouldn't want them to. But I can see them owning sort of 5 to 10 brand new properties because you tend to get better yields and tax deductions, and it's just easier, right? And they still get capital growth as well. So we found I guess our niche, and it just works for us. But these guys that do this strategy, yes, it works. Standalone properties, they can get really, really good deals. They can pick up under market value, make money straight away on the buy, and there's nothing wrong with it because sometimes it's all people can afford.
Yeah, and it's catering for a particular client or customer where you found over time the people you were dealing with, which everyone is different, required some other solution. They didn't have enough time, money to spend on that kind of stuff.
And these guys at the time, because I was driving a Toyota Corolla, I was new to the business, I was fresh to the industry. The clientele I was dealing with didn't have that much to spend. Like I remember having to buy something for a client for 250 grand, and he couldn't go $1 over 250 grand. Yeah. So like we had no choice. And I remember dealing with those clients, and I'm glad I helped those guys out, but I remember thinking, I really got to upgrade my clientele base because I need to be thinking with bigger people. I need to be helping people with a bit more, backing behind them so I can scale out their portfolios a little bit easier. And look, there's plenty of other companies out there that deal with this cheaper stuff, and we refer that type of work to these firms, and it was just a natural progression for us in the business. So then we moved on to existing properties, but we started doing renovations for clients. Nothing massive, just like quick cosmetic stuff, nothing structural. And this was good. Like we were able to force appreciation, get that capital growth, and basically tap into that equity and go into the next one. Again, it was a lot of hard work. You're then dealing with, separate trades that you didn't have consistent work for. And there are other guys out there that do this really, really well because they do it in volume. They've got better relationships with their trades.
Or they might be tradespeople themselves.
Or they might be tradespeople themselves. And we've had clients come in who have been tradies, and they have looked at our strategy and said, you know what, like I can do better. And we always say, if your alternative is to get a better return somewhere else, then go and do it. Because it's still a great strategy. Like they call it in America the BRRRR strategy.
What was that stand
buy,
Reno,
refurbish, refinance, rinse and repeat, right?
Okay.
So I think that's what it is. So it's basically just buy an existing place, do it up, and then refinance it, and then take the equity out and go again, right? And I did that, right? And that's why we started recommending it, because I did it. I got great results, Sam. You know, I think we did one. I think we made 200 grand out of a reno once.
Was that you, or did you do? How did you go with the client and them having to go through the process of
It's
that?
a headache.
Was that hard for the client to?
Yeah,
Because it's not set and
and
forget.
look,
I got to deal
and
with
to be
shit.
honest with you, I found that my clientele didn't want to go through it.
Yep, okay.
And I'm sure there's clients out there that are willing to weather the quotes and the delays and not having rental income for a while and all of that sort of thing for that forced appreciation. What I do like about that strategy is that if your goal is solely capital growth, like, it's great.
Yes.
Like a new build, for example, that's going to take you 6 to 8 months at a minimum. So like, and it can go all the way up to say 2.5 years, depending on what you're building. So with renos, like, you can get them done in 3 months, even 6 weeks, right? So it depending on how, you know, intense the work is, but it's great for capital growth because you can force that appreciation quickly. You can tap into that equity like straight away, and you can see the results before your eyes, right? So it's awesome, but you miss out on income. You don't really get many tax deductions. I mean, you can after you renovate it, but if you're trying to renovate it cheap, then obviously there's going to be less tax deductions.
So that would be suitable for someone with a little bit more money than the cheaper buying property that can actually do that. So really, you need a bit more capital up your sleeve to get that done.
Location plays a big part in it as well. So we were finding that a lot of people were just buying anything and then going, oh, there's renovation potential. But if you've bought in a rubbish location, then you're sort of pushing shit uphill to try and extract value from that sort of property itself. So you want to sort of be in better markets and all of that sort of thing. So you're sort of spinning wheels but not going anywhere sometimes with that strategy, and there's a lot of risk. Like, it might not work, Sam, you know, and there were times where we didn't really see a result. We might have seen a result in maybe a better rental income, but it wasn't groundbreaking to the point where we're like, wow, that was awesome. So I think I did that strategy heavily for a long time because that's what I grew up with. I watched my parents do it with their investment properties, and they did really well, you know what I mean? But they didn't have a portfolio of 10 properties. They might have had 2. And it's easy to manage that way. If you are just buying maybe your home and maybe one other investment property, then that could be a strategy for you. But there's so many different factors at play that will determine whether that's the one for you or not. It worked for me at the time because I had a high income. I was able to sort of, well, not just a high income, it was more so just that I had disposable cash that I could deploy into it. So you're talking 20% plus stamp duty. You've got the renovation costs, also being able to withstand the vacancy of not having any cash flow. So it was, you know, like, it worked at the time. It got me to a certain point, but again, wasn't scalable, wasn't sustainable. So we had to sort of start looking at other things.
You've been dealing with clients generally for a long time. Have you found over time, because what I see with myself getting older and just living longer, is time and money is always an issue. It becomes harder and harder. You want to squeeze as much as you can out of both. Have you found over time, because this requires a bit more time and money and people are lacking of it as they get older with more responsibility, are you finding as you grow older and your clients maybe grow with you, they're less willing to do this stuff, and that's hence other projects? We can only speak for our clientele, right? Because we do get the odd client that comes in here and there and says, oh, what do you think of this strategy? And it might be good for them, right? But the majority of time, the people that walk through our doors, they want to use as much of the bank's money as possible. They want to leverage up as much as possible. And most of them are on decent incomes and they're paying quite a bit of tax, and they actually want the tax deductions. Now,
they're not investing in property solely for the tax deductions, right? And that's where a lot of these other guys slip up and go, you shouldn't invest in property just for the tax deductions. Yeah, it's true what they're saying, but it's just really a bonus that we're saying, okay, it helps you cash flow the property in the initial stages. It's not, we're not saying, hey, because you're paying heaps of tax, you need to come and buy this property. There are other factors at play as well. But yeah, our typical client is time poor. They're also cash poor as well. When you think about it, their income, their servicing is actually quite good, and they want to leverage as much of the bank's money as possible for tax purposes, but at the same time to take advantage of being able to get the money from the banks. So doing existing and a renovation, it's a bit more capital intensive, right? And that's where the risk is. And even if we're using equity, I find that clients don't want to risk that equity on a reno, which they feel like it's the unknown. And look, I can't change the way people think, right? And people are much more comfortable going, hey, have you got some? Like, we always try and do pre-construction because we believe that the money is made in construction, and that's what our business is based on, construction, right? We want to create that margin for our client, that 15, 20, 25% margin that a developer would normally make. That's what we want our clients to make, right? Now, all of these other property gurus out there aren't saying that about our strategy, right? They're not saying that. All they're saying is, oh, the shit house and land package.
They're not saying what benefits that come from that strategy.
There's so many benefits. And look, there are a lot of shit house and land products out there, right? And especially the ones that are ready to go because the margin has already been made. But if you're in a good market and you've got a great relationship with a volume builder, like, you can do it really, really well. So that's the majority of our clients. They want to do that because they know they can leverage it up as much as possible. It's a packaged up sort of deal. They know we will run the construction for them. It's easier for them, right? And they've seen the results. Like, we've got plenty of success stories, right? But with the existing in reno, it's sort of like, well, you don't normally borrow for the renovation. That's usually cash. And then the client's already put cash in as a deposit and stamp duty. So
it's a lot of money.
They've used up a lot of their cash, which they didn't really want to. They could have. They probably look at it and go, well, Zah, I could have bought 2 properties, right? Through your strategy. So that's where we sort of gone, okay, well, this is very time consuming, this strategy. It's very, very hard to convince clients to do it. Why should I push shit uphill? You know what I mean? And look, maybe it's because I don't have the right contacts or the right volume to be able to do that work, but it just doesn't work for us as a business. And look, I don't do it myself personally either. So everything for my clients is what I do personally, and I don't do that anymore.
And why? It's because you found better efficiencies. That's
more efficiencies.
So you then graduated to looking into granny flats.
Yeah, so because it was unsustainable in terms of holding the existing and the renos like throughout the whole thing, cash flow became an issue, right? So we started looking at granny flats, and I must admit, I didn't do a hell of a lot of them, but we did them at a time. How much were they back in the day? They were only about 120 grand to build. They were so cheap.
I seen them even cheaper.
They were so cheap, and actually quite good. That'll give you 60 square meters. Obviously you need the property to be able to do it. I think it was 450 squares plus or 500 plus back in the markets we were dealing in. They needed site access and all of that sort of thing, but clients loved it. And look, it was great for cash flow. It was great for depreciation as well because it was a brand new dwelling. But not every property could do it. And there's a guy that who's doing it at the moment. He's doing it quite well, and he actually specialises in finding properties that have granny flat potential, and that's really, really good. But again, we don't normally borrow for granny flats, and they don't become strata titled where they can be sold off separately. It's the one property. So it's almost like a dual income asset, right? Or it is a dual income asset. So it was great for guys who were needing that extra cash flow. It was it was a really good strategy for people that had the cash
Yes.
to be able to do it. But most of the time, they weren't going to the bank saying, hey, I want 120 grand to go and build this thing. It was really coming from cash or equity, right? So it was a certain type of client that wanted to go through that process as well. Where I found that fell over a little bit, well, not fell over, where it became a little bit annoying was that you would have to discount the front property for rent.
Yeah. Because it had the granny flat out the back.
While it was being built.
Oh, yeah.
Right.
Okay.
And then also, when it was built, you had to, because it's less yard space. But overall, great strategy. And I just found that not a lot of people really wanted to do it. It was just, you know what it's good for, Sam? It's good for guys who like are really in the property space.
Yeah.
Like guys in the industry, they love it. So guys like you and me, like we would look at that and go, yeah, that's a cracker sort of strategy. But the everyday person, what I found was, oh, Zach, can you just buy me a property that already has a granny flat on it?
They don't want to go through that
or
process.
if you're going to build a house and land, can you also, I got this question yesterday,
Yeah.
can you also find me a block that we can build a granny flat on the back as well? So they want it all done for them. I think having the existing property was probably too much work on its own as it is, and then saying, hey, do a granny flat. So there's a market out there that definitely would take that on, and I think it's a great show. I heavily endorse it, but it's a lot of work, right? It's a lot of work, but also you've got to also understand is that finished product is going to appeal to mainly an investor. They're saying multiple families can live there, and that's great. You're going to have that clientele there as well, but mainly an investor is going to be looking at it because of the numbers, right? So we're very much about wanting owner occupiers looking at our products. So, you know, a typical buyer, when we resell our stuff, we want them to come into the property and go, I could raise a family here. I'm emotional about this purchase. I'll spend an extra $100,000, $200,000 on the purchase price because I just want it. And my wife's a pain in the ass telling me that she just doesn't want any other property to live in. And then that's when those emotional purchases push up those prices of those owner-occupier appeal properties. So that's where we're like, okay, well, it's great for cash flow, but we're sort of almost stunting our capital growth and relying on, I guess, the market per square meter in the locations that we've bought and built in to rise in value.
And the rents and stuff over time to appeal to an investor. Right?
Correct.
To buy off. Yeah.
Correct.
So I've seen a lot of this happening between 2010 and 2020 in tax. I saw a lot of clients coming in. There was probably a granny flat dude spruiking that type of strategy at the time. And I saw a lot of clients would go for that for the higher yield. They wanted more rent.
Well, it's big now.
From the house, because the house doesn't generally give you much.
And it's big now because people need the yield.
Because things are so tight. So I think it has its place. Like you touched on, it's not for everyone, but it's a really great strategy. Tax benefits as well, but definitely I see the impact on the capital growth side. A lot of people won't, it's going to limit your buying pool later, who's going to buy it off you, and maybe the valuation of the property for maybe refinancing, because they're going to see it not as a home with a maximum value potential. So it has its place. Question for you, would you do it again?
Yeah, okay, so that I was actually going to get to that. So I've actually got properties in my portfolio, like older ones that I've still kept, that have granny flat potential.
Potential, okay. Yep.
Now, I don't need the cash flow straight away. Yep. Well, it'd actually be nice now in this high interest rate environment, but hold those properties with granny flat potential, and then you can potentially do it later down the track. Yes, you'll probably pay more for the granny flat because construction prices increases, but that's when maybe the property's paid off and you're entering the cash flow stage of your property journey, and then you want to just get that extra yield. You're sort of not buying property anymore, so instead of putting deposits down, you put it into the granny flat.
Like you're maximising your existing...
Correct. So that's what I would do now if actually we just bought a place that has the granny flat potential, and we won't do it straight away, so we'll do it later on down the track. So yeah, like I think it's still a really, really good strategy. Is it for our clientele? I don't believe so. I think it's got too many moving parts. But I think the guys who are really cluey and they really want to get educated on it and really want to get involved with it, yeah, it is a pretty good strategy. But you do need some money to do it,
money
right?
and time.
Like for example, if you're paying 150 grand for a granny flat alone, a lot of our clients will go, well, I can buy another property.
That's a deposit, yeah.
Right?
It's a
So,
deposit,
I think at a certain time it'll work, but yeah, we didn't really get too much traction with it because everybody's in their growth accumulation stage wanting to acquire as much property as possible. And the market's getting away from them, you know?
Then you moved on to development.
Oh, okay. So this we talked about this when we started the podcast about how Luxland started.
Yes.
So we did we had the development. So all of the stuff that we've talked about previous to this were my personal experience before Luxland, and this is when Luxland started. Luxland started with the 4-pack development. We've already talked about the returns and how much it cost me and how hard it was, and it just taught us a lot. I wish you could still do 4-packs now under residential lending, but you can't, unfortunately. I think it's a maximum of 3 now. Would I go back to a 4-pack? Well, I'm actually in the process of selling a site now, which is DA'd for 4. I'm not interested in going through the whole commercial finance funding process. Maybe I will later on down the track, but that's just something I just want to pass on for now. Banking at the moment is tough as it is, so I think we just hit pause on the 4-packs for now. But look, that strategy taught me a lot, right? It taught me how to deal with builders, how to create a margin through buying land and getting a wholesale builder in, and then sort of manufacturing that profit, not just for me but for the client as well. So that was basically where Luxland was born. So if it wasn't for this 4-pack, Luxland wouldn't exist, right? So it gave us such a good launching pad. And then when we went back to existing stuff, so we started buying blue chip existing stuff, so in really, really good locations. So you're talking like the Merryweathers and the Adams towns of Newcastle, Central Coast. We were trying to be, as close to that CBD as possible. And like for us, it was blue chip. We're not talking eastern suburbs or anything here. But we tried to really focus on location, and we didn't really care about the condition of the property because we were like, okay, well, we've mitigated our risk through the location. Even if we throw money at a renovation, we're not really going to overcapitalize, because if we're in a strong market, which most of those blue chip markets are, like you've basically made a profit, and it's how we look at developing now as well. Again, low yield. It was hard to hold on to. It was hard to scale. It was great for clients that wanted to just do 1, 2, maybe 3 properties. But then, the maintenance issues, like a building's a building. If it's, 40, 50 years old, it's going to need maintenance. So, the capital growth side of things was great because you're in markets that are so strong. To sustain that strategy to keep moving forward, it was, and look, there are other guys out there that are doing this very, very well, and they're spending a lot of time on creating content and education on how to hold these properties. But the thing is, it's hard for clients to actually do it. Like, that's what I've found. It's hard enough for clients to do something that is probably the easiest thing to do in property. So I just found that it was just big price points to get in as well.
Because it's blue chip.
Yeah.
That's what I was going to ask you. Like, you started within the existing space, and you sort of did granny flats and different sort of cosmetic reno stuff to development sort of space. Then go back to blue chip. Is there a reason you sort of went back to existing stuff?
I knew it.
You knew it. Okay, so you went through some cycle.
I didn't feel confident enough to. Even after doing the granny flats and the 4-pack townhouse, I didn't feel confident in the whole construction side of things. I was comfortable with existing. I was comfortable with renovations. I was comfortable with picking the right locations, because I had bought them myself and I'd been doing it myself.
And it would have performed over time, so you saw that worked.
Yeah, and I also followed quite a few people in the industry who, I wouldn't call them mentors because I didn't really reach out to them, but just from afar read their books, and they were into this, right? And it was a great strategy. Like I still hold a lot of those properties in my portfolio now, and they've done very, very well for me. But they cost me a lot of money to run. Like they have so many maintenance issues. You know, the yields are very, very low. There's no tax deductions on it. And there's only so many that I could do. And I'm like, there's got to be a better way. Like, I don't want to own 100 of these, right? So I moved on. And I did my first house and land package. And I was so opposed to house and land, Sam.
Why?
I just heard...
Were you listening to those dudes?
I was listening to those guys, and you know, you hear of the horror stories, builders going bust, people buying in shit locations, and I just generalized it, just like all of these other guys. And it was funny, like I got referred to this client, and they're very close family friends of ours now, and I was still on my whole existing blue chip sort of strategy, and I was trying to pitch them this deal. And these guys were at the time, they were in their mid to late 40s, so they were a bit older than me. They were on good incomes. They lived, you know, in a $2 million house, which was virtually paid off. You know what they said to me, Sam? They goes, we don't want any of this older stuff. We just want something brand new and ready to go. And, you know, like we don't want the issues with maintenance. We actually want the tax deductions. And
did they have property at the time?
No.
Okay, so they hadn't experienced it, but they didn't want it.
And so that was the first meeting. And I went away and I thought, no, I'm gonna convince them that my strategy is good. So I went back to them and tried to convince them, and they said, Zah, we're not having any of it. Like we actually want to engage you, but we want something brand new. We want something that's just ready to go. We want warranties. We want the highest return we can get in terms of rental. We need the tax deductions because we're both on a combined income of like, I think it was 350 grand a year. But we do want to do something with you, right? And I was like thinking, okay, well, I actually don't have a choice, because at the time, like I was trying to get any business I could get. You know, we weren't making money. Like I was struggling, right? And I thought, but I had integrity. I was like, no, this is my strategy. This is what
Look what I've done. I can do the same.
This is what I've done, right? And because I hadn't done a house and land myself, I didn't feel comfortable. So I went out and sought advice from my solicitor, and he had done a few house and lands as well. And he said, no, you'll be right. Like you can make it work, and you know there's a good margin in it for everybody, and you know let's put it together. And so anyway, we did this dual income property, and it took us about, I think, 8 months to build. Total price, package price was like 600 grand.
Wow.
And I think today that property's worth, it'd be probably 1.1 million.
Wow.
And the clients were rapt. They had us over at their place for lunch and, you know, to introduce me to their families. They loved the process. And it was the first time I started doing personalized videos for clients, because I was taking progression videos of the build. So every stage that they would pay a progress payment, I would go out on site and I would hold the iPhone up and I would do a personalized video, and I would WhatsApp it to them and say, this is the update of me on site. And they loved it. And they had such a great experience out of it. I was like, wow, like I actually got to do this more. Because even at the time when I was doing it, I was like, oh, I'll just do this one because they actually want it. And then I started thinking, okay, well, I need to get more educated on this. Like I need to start meeting more builders. I actually enrolled into another property investment firm that got referred to me from a friend. And I even went to them and I paid them lifetime membership fee. And I was like, I need you guys to help me do a house and land. And they actually knew I was in the business. And they helped me do a house and land, my first one, for $1 million.
Wow.
And I remember saying to them, because they were recommending stuff at like 700-800 grand, and I said, give me the best house and land you can. I really want to prove to my clients and to myself that it works. Give me the best house and land you can. So we did one where the land cost 500 grand. This was up in Brisbane, and it was good because I had the help of that company to help me with the interstate locations. Yeah. The build cost me 500. At the time, we did it through Metricon.
What year was this roughly?
I think I bought the land. I put the deposit on the land in 18.
18, okay. Yeah.
And then, but the build didn't. The land didn't register till like 19, and then the build didn't finish till like end of 19, start of 2020, right?
Okay.
So anyway, we built it for $1 million. We on completion, it was worth 1.2. So there was a 20% margin in it, which was great. It started renting for I think $1,000 a week straight away. But then within a space of I think 2 or 3 years, it jumped up to $2 million.
Insane.
And I was just like, if I do that 10 times, that's $10 million worth of profit. And that was easy. Like we can do these builds in like 6 months. So I started having meetings with every builder that I could, right? And just trying to do deals in terms of, okay, if I bring you volume, what can we do, blah, blah, blah. Just, I'm trying to get that square meter price down. And then I'm started meeting with land developers and all of that sort of thing. And mate, the rest is history. Now I'm the king of house and land, right? And I think if it wasn't for those 2 first deals, the one for the client, which, I was basically forced into doing, and the one that I did for myself to really prove to myself to go, hey, this works for clients, man, like I wouldn't have done it.
It's a great story, and it highlights how it depends on the person, what their scenario is, what they're trying to achieve. Because you tried to give that first client something you knew worked, but they didn't want it because they had other goals. They didn't want maintenance and all those issues. So it just shows you that you can win with a strategy. You just got to pick what suits you. Yeah, that's all.
Yeah, and look, what I've found is with our strategy is that it's so user-friendly, and people get a bit off it because they think, I've got to go through the construction process, but that's where the magic is.
It's exciting too.
That's where the margin is. Yeah. That's where you're creating value. Like instead of doing a renovation, you're actually doing a new build, right? So, but the beauty of it is, with the renovation, usually you have to fund it with cash. With the construction, you can get a construction loan, and you can borrow up to 90%, and the banks love it, and it only takes you 6 months if you know the right people. So if you do it in the right locations, which we always do, and you've got a reputable builder who's giving you a good rate and also delivering a great quality build, man, it's a recipe for 15, 20, 25, sometimes 30% profit margins, right? So that house and land, for example, that I did it at a point where I didn't have a lot of capital. I put $150,000 into that deal. I did a 90% LVR, meaning I put a 10% deposit in. If you include lender's mortgage insurance and stamp duty, it came to about $150,000 in cash. Turned it into $1 million. Like after I did that, I'm like, I got to tell everybody about this. Like this is like, I now have the answer, extreme confidence in being able to make this work for everybody. And we have done so well at it. We've done hundreds now. Like we've done ones for clients where they've spent 700 grand and it's now worth almost $1.5 million, like 1.4 million. Like it's doubled in value. Like it's incredible what we've done. And, some of them we've done it in short periods of time. Some of them, if I had to wait 5-6 years for it to double. But man, all of these guys that are talking shit about house and land packages, like your heads need to be read. Like you can't put us in the same bucket as all of the other shit out there. Now I must admit, 95% of it is really bad out there. It's like saying the Australian property market is shit. Yeah, 95% of it is shit. 5% is the ones that we want to invest in. So we've been able to make it work, and that's my niche now. Like it's something that it's literally 95% of our business now is house and land. And the reason why people keep coming back is because it works.
The result.
Like you've done it.
Yeah. Indeed. Now what did you go on to?
Okay, so after that, I was like, okay, I need a bit of diversity here. And this company that had taught me to do the house and land, they also were into townhouses and apartments. And I used to be so against them as well. And I'm like, why? Brand new townhouse, a brand new apartment. They never make any money.
Again, you listen to other people talk and probably shit
Correct.
about it. Yeah.
And what they explained to me was the townhouses, they're a really good midpoint to access locations where housing is too expensive.
Yeah.
So for example, I've got a townhouse in a suburb called McDowell.
Yeah.
To buy a house in McDowell, you're looking at $1.5, $1.6 million, right? I've got a townhouse there in the same suburb. It's a 3-bedder, house-like interiors in terms of sizing for 850 grand.
Wow. Yep.
Now that rents for $800 a week. So you get the yield, but you also get the location that you wouldn't have been able to afford if you had bought a house there. And every townhouse that I've bought in my portfolio, and you're the same, it's outperformed everything else in terms of yield, tax deductions, capital growth.
Across the board, as a balance.
It is the best product. It is the best product for an overall, if you're trying to hit all of those three things. And, you know, obviously location plays a part, and it's hard to do now. There's not many really good ones out there. And everything, you know, seems to be overpriced. But, you know, back in the day, it worked. And these guys taught me how to do it. And I've gotten lots and lots of clients into them, and we have clients beating down our door trying to get into those projects now.
I want to do one. There's none. There's none.
There's none available. And it's the same with apartments, right? Like apartments get a really bad rap. And, you know, we need to understand, and this is what this company taught me, is that you need to have a rental growth strategy in your portfolio. And rental growth means that if you've got something renting for $500 a week, and then next year the lease gets renewed and it's now $550 a week, then you've had a 10% increase in rents. You sort of don't get that percentage rate in, say, houses, because you're not in those locations where you've got the ability to push them up. So this is where people focus on, oh, apartments don't grow in value. And it's like, well, you're sort of buying it for the rental growth, and it's not going to happen overnight. So you need to understand that different types of properties do different things for you. And we can't say, oh, never buy this type of property. It's like, well, if we're trying to get that rental growth and we want our foot in the door into that location, that's why we should buy that, right? And they just get such a bad rap for no good reason. Now, the thing is, you don't want all apartments in your portfolio, right? You need a balance, and everybody's different, and you got to figure out what purpose you're going for. Is it solely capital growth and you don't care about the yields? Or is it something where you might need something in your SMSF that has that rental growth capability over the next 15, 20 years? Like a 1-bedroom apartment in where I'm living now, Sam, 50 square meters internally, renting for $1,000 a week.
Wow. Massive.
Right? Like that's rental growth for you. You'd be happy if you owned that, right? So that's where that whole idea of apartments came in and sort of squashed the, I guess, stigma behind it.
It's your business and your journey itself. You can see how you actually delve into them and find the benefit. And then you can take that on board and help the client utilize, I guess, expose. You know,
well, we've experienced it. We've experienced it. And every time a client comes to us with an issue or a problem, we're able to say to them, hey, this is normal. We're all going through it. Don't worry. It's going to get better over the next 2-3 years. Like you've got that experience, and that's a big thing for me. Like I've always wanted to do it myself before recommending it to a client, and then also not recommending something to a client because I've done it before, and I can tell them, no, don't do that, right? We've doubled in commercial as well. Something we don't recommend our clients to do until they're sort of on the back end of their portfolio. We've got some really good contacts in terms of commercial guys who this is all they do. They're actually local here, really, really good people. We do all of our commercial stuff through them. Haven't done a hell of a lot. It's capital intensive. You need to have much bigger deposits. Financing's more expensive. So it's really, really good for guys who have built their net worth up. They've got their capital grown to a certain point, and they're willing to now go, okay, let's transition into this commercial space. So the guy I do commercial property with, he also does residential, and his advice is always leverage up as much as you can through residential, let them all grow in value so you've got an actual big capital base to start from, and then pour it into commercial afterwards, because then you're wanting that cash flow on the back end of your, I guess, lifestyle phase of property investing. But hey, commercial's great. It's just an expensive sport, you know, like.
Well, you have to graduate to get there. That's the thing. You can't think as a noob or entry level guy, you're going to get there quick. You have to build up, like you said, the horsepower behind you.
The good stuff in commercial is between 3 million and say 10 million. So let's say the entry is 3 million for something decent, right? You can get cheaper, but for something decent, your deposit on that is like 1.2 million with stamp duty. So like, that's a lot of cash to have to deploy to that strategy. And if you don't have that net worth yet, then there's no point even looking at it, right? So most people are starting at the beginning where they've got maybe $100,000 in savings or equity, and they want to grow that to 200 and then to 400 and then to 800. And the only way you're going to do that is through really smart residential investment, but then also using the bank's money to your advantage, because you can leverage up more, borrow more money. And look, that period can last anywhere from say 10 to 15 years before you even consider commercial. So don't try and rush it.
Is that usually where your clients would get to in terms of what's the end goal? Is that what the advice from you is usually like, okay, you do the resi stuff to a certain level, then it's time to change tack?
Yeah, so what we say is, you start off with say apartments, townhouses and houses. Dependent on your situation, you get a portfolio of those assets, let them all grow in value. Then you transition over to either two things, commercial property or developments. So development is I'm more suited to development because I've got a higher risk tolerance. And I love the construction side of things. I love I just love building, and I love being able to create that profit margin in a short period of time, where commercials is a little bit more passive. It's a little bit more boring, but if you get it right, it's a sure thing. So everybody's going to have different risk appetites. My risk appetite might change in 5 years' time, and I might go, okay, I'm just going to go all into commercial.
But that's the space you'll be playing in, because you've already sort of graduated.
When you've got the bigger numbers, that's what you want to be doing. So I guess the last one is back to development. So we're about to launch this product just in time for our birthday to celebrate. It's a duplex product, and we're doing a couple of these ourselves in the Newcastle market, so in New South Wales. I believe that this strategy is much better than the townhouse strategy. It's a lot less risk. It's literally like building a house and land, but it's probably taking maybe 2 or 3 months longer. But then you end up with two properties that you can strata title and sell off separately. So there's a bit of a margin there. We're looking at anywhere between a project cost of $1.5 to $3 million. But if you're putting a 20% deposit in plus your costs, you're generally getting that back out on the feasibility as profit. So I like that strategy at the moment because it's still considered quite small, but it's not big in a way where it's a 3, 4, 5 pack where there's so many other moving parts, like different financing models and different consultants that you need.
The amount of time as well it takes to complete.
And risk as well, Sam. Risk in this current environment where, you don't want to be, like a lot of the bigger guys are now doing smaller things. So that's the way we've got to think as well. It's like, and it's not going to be like this forever, but in order for us to keep working and moving, we still want to be doing decent sized projects, but we don't want to be putting everything on the line and risking it all. So that's what we're going to be encouraging our sort of more experienced clients to be doing. Equity needed for something like that's going to be at a minimum of say 350 grand, which a lot of people have in their portfolios or in cash if they've got a good job or a good business. So that's what we're going to be focusing on probably for the next 1 to 2 years. We've got a couple going already that are looking really, really good. So we'll be releasing a video on that very soon. But all in all, there's no best and one strategy that you can say, okay, you should be doing this. In concluding all of everything that we've said, like everybody out there who is spruiking a particular strategy, there are good things associated with it. Is there a best one out of them all? Well, no. That's like saying, what's the best food that you can eat?
There's a lot of preference. It's subjective. That's the thing. It depends on who's consuming it.
Exactly. So like, if a certain, and we are open with our market and audience as well. Like if we think that you are suited to one of these other guys out there that are spruiking existing in renos or cheapy properties and stuff, we'll actually refer you to these guys. Like there's enough business out here for everybody to take. But I think our message is to everyone is like, sort of, when these guys like sort of bag out, certain strategies, just watch what they're saying. They do have some merit, with certain things, but most of the time they're not really drilling into the detail with everyone's, I guess, preferred method. And I know for a fact, because just from this podcast, we have talked about me doing nearly every one of those strategies that are out there, and they've all got their pros and cons.
And generally speaking, would you say you've essentially, with each project you've done in a different space, you've actually done quite well? So all of them would do well if you do it right, in a way. Well, if you do it right, and you might want to come and see us, maybe when you've done 3 or 4 different projects with some other guys, and you go, okay, now it's time for me to do a duplex with Zar. Or you might want to do us first and then go to them later. Like there's no right or wrong, Sam. You know what I mean? Everyone's just trying to get ahead. So what's right for you is not going to be right for the next person. So I think it's just understanding your position. And also, one of the biggest things that we've been talking about lately is that with clients, if you don't feel comfortable with the people that you're working with, don't work with those people. And I say that all the time about our service. If you don't feel comfortable with us, like, go somewhere else, because it's the last thing we want you to do is to feel uncomfortable. But if you trust the people that you're doing it with, and you believe in their strategy, and run with it, marry it. You know what I mean? But don't look behind you and go, oh, I could have done this, I could have done that. So yeah, a lot to think about. What a journey, man. Yeah, what a journey. Congratulations, 10 years.
Thank you.
You've helped a lot of people, including myself. So on behalf of everyone, thank you.
Thank you, Sam. It's been an absolute pleasure, and hopefully we can get another podcast in before the end of the year.
Sounds good.
Before we turn 11. All right, guys, I hope you enjoyed that one. I'll see you again soon. Take care. Bye-bye.